Welcome back to the channel, everyone. Today, we're diving deep into a topic that's essential for anyone serious about building long-term wealth: the best ETFs for long-term investing. And I don't just mean ETFs that you might hold for a few years and then trade out of. I'm talking about funds that you could literally buy today, tuck away in your portfolio, and hold for decades as the foundation of your financial future. We'll be covering 4 powerhouse ETFs that are widely considered some of the best options for long-term investors. VOO, the Vanguard S&P 500 ETF. QQQ, the Invesco Nasdaq-100 ETF. BND, the Vanguard Total Bond Market ETF. And SCHD, the Schwab U.S. Dividend Equity ETF. Each one of these ETFs has a unique role to play in a diversified portfolio. Some are designed for broad market exposure, others for growth, others for stability, and some for income. By the end of this video, you'll not only understand what each ETF is, but also how they complement each other, and how you can build a long-term strategy that matches your own goals, whether that's early retirement, steady income, or simply compounding wealth for decades to come. So, grab a coffee, settle in, and let's get started with a masterclass on long-term ETF investing. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Before we jump into the specifics of VOO, QQQ, BND, and SCHD, let's take a moment to talk about why ETFs are so powerful for long-term investing. An ETF, or exchange-traded fund, is essentially a basket of securities, usually stocks or bonds, that you can buy and sell just like a single stock. The beauty of ETFs is that they give you instant diversification. Instead of buying one company and hoping it succeeds, you're investing in hundreds, or in some cases, thousands, of companies all at once. Now, why is this so important for the long term? Because the reality is, picking individual stocks is extremely difficult, even for professional investors. Over long periods of time, most active managers, people whose full-time job is to try and beat the market, actually underperform simple index funds. ETFs, especially those that track broad indexes, allow us to match the market's performance with very little effort and extremely low fees. Think of it this way: if you put your money into a single stock, say Apple or Tesla, yes, you could see huge gains. But you could also see big losses if something goes wrong with that company. If instead you put your money into an ETF that holds hundreds of stocks, then even if one company struggles, the impact on your portfolio is much smaller. That's the power of diversification. For long-term investing, meaning 10, 20, or even 40 years, the most important factors are staying invested, keeping your costs low, avoiding big mistakes, allowing compounding to do its work. And ETFs check all those boxes. Most of them have very low expense ratios, meaning you keep more of your returns. They're easy to buy and hold in any brokerage account. And they remove the temptation of constantly trying to trade in and out of individual stocks. So, whether your goal is to retire comfortably, to build generational wealth, or to create a portfolio that pays you passive income for life, ETFs are an excellent tool to get you there. In this video, we're going to explore 4 ETFs that each represent a slightly different strategy: a broad market index fund, a growth-oriented tech-heavy fund, a bond fund for stability, and a dividend ETF for income. And together, they can form the building blocks of a well-diversified, long-term portfolio. Now that we've laid the groundwork, let's dive into the first ETF on our list, one that many consider the gold standard for long-term investing: VOO, the Vanguard S&P 500 ETF. Before we jump into the specifics of VOO, QQQ, BND, and SCHD, let's take a moment to talk about why ETFs are so powerful for long-term investing. An ETF, or exchange-traded fund, is essentially a basket of securities, usually stocks or bonds, that you can buy and sell just like a single stock. The beauty of ETFs is that they give you instant diversification. Instead of buying one company and hoping it succeeds, you're investing in hundreds, or in some cases, thousands, of companies all at once. Now, why is this so important for the long term? Because the reality is, picking individual stocks is extremely difficult, even for professional investors. Over long periods of time, most active managers, people whose full-time job is to try and beat the market, actually underperform simple index funds. ETFs, especially those that track broad indexes, allow us to match the market's performance with very little effort and extremely low fees. Think of it this way. If you put your money into a single stock, say Apple or Tesla, yes, you could see huge gains. But you could also see big losses if something goes wrong with that company. If instead you put your money into an ETF that holds hundreds of stocks, then even if one company struggles, the impact on your portfolio is much smaller. That's the power of diversification. For long-term investing, meaning 10, 20, or even 40 years, the most important factors are staying invested, keeping your costs low, avoiding big mistakes, allowing compounding to do its work. And ETFs check all those boxes. Most of them have very low expense ratios, meaning you keep more of your returns. They're easy to buy and hold in any brokerage account. And they remove the temptation of constantly trying to trade in and out of individual stocks. So, whether your goal is to retire comfortably, to build generational wealth, or to create a portfolio that pays you passive income for life, ETFs are an excellent tool to get you there. In this video, we're going to explore 4 ETFs that each represent a slightly different strategy: a broad market index fund, a growth-oriented tech-heavy fund, a bond fund for stability, and a dividend ETF for income. And together, they can form the building blocks of a well-diversified, long-term portfolio. Now that we've laid the groundwork, let's dive into the first ETF on our list, one that many consider the gold standard for long-term investing: VOO, the Vanguard S&P 500 ETF. First, let's talk about diversification. When you buy VOO, you're not just buying Apple or Microsoft or Amazon, you're buying them all, along with hundreds of other leading companies across different industries. VOO includes companies in sectors like technology, Apple, Microsoft, Nvidia; consumer discretionary, Amazon, Tesla; healthcare, United Health Group, Johnson & Johnson, Pfizer; financials, J.P. Morgan Chase, Bank of America, Berkshire Hathaway; industrials, United Parcel Service, Caterpillar; and many more. This kind of diversification reduces your risk. If tech stocks have a bad year, maybe healthcare or financials pick up the slack. The second big factor is cost. One of Vanguard's hallmarks is keeping fees extremely low, and VOO is no exception. The expense ratio for VOO is just 0.03%. To put that into perspective, if you invest $10,000 in VOO, your annual fee is just $3. That's it. Compare that with actively managed mutual funds, where fees are often 1% or higher, $100 or more per year on that same $10,000 investment. Over decades, those fee savings add up to tens of thousands of dollars, maybe even more. And third, performance. Historically, the S&P 500 has returned about 10% per year on average since its inception. Now, of course, that's an average. Some years it's up 20%, other years it's down 10% or 30%. But over the long run, the S&P 500 has been one of the best wealth-building tools available to everyday investors. Let's take a moment to think about compounding with VOO. Imagine you invested $10,000 in an S&P 500 index fund back in 1990. If you held that investment and reinvested all your dividends, today it would be worth well over $200,000. And that's without you doing anything, no trading, no stock picking, no worrying about market timing. Just buying, holding, and letting the market do its work. That's the beauty of a fund like VOO. It allows you to benefit from the overall growth of the U.S. economy without needing to guess which companies will succeed or fail. So, what are the biggest advantages of VOO for long-term investors? Simplicity. You don't need to overthink it. By buying VOO, you're getting exposure to the largest and most important companies in America. Diversification: 500 companies across all major sectors. Low cost, expense ratio of just 0.03%. Proven track record: the S&P 500 has delivered solid returns for nearly a century. Dividend payouts: while not a high-yield fund, VOO does pay dividends, currently around 1.5% to 2% annually. Those dividends can either be reinvested for growth or taken as cash in retirement. But let's be fair, it's not perfect. What are the drawbacks of VOO? US only. VOO focuses exclusively on American companies. That means no international exposure. If the US economy struggles while another region of the world is thriving, you won't benefit. Large cap focus: VOO only includes large cap companies. That means you miss out on small cap or mid cap stocks, which sometimes deliver higher growth. Market weighted concentration: the S&P 500 is weighted by market capitalization. That means the largest companies dominate the fund. Today, Apple and Microsoft together account for over 13% of the index. Add in Amazon, Nvidia, and Alphabet, and the top 5 companies make up more than 25%. In other words, while it's diversified across 500 companies, it's heavily tilted toward the largest ones. VOO is perfect for the investor who wants a set it and forget it approach. If you don't want to constantly research stocks or try to time the market, but you still want exposure to the long-term growth of the U.S. economy, VOO is one of the best choices out there. It's especially powerful for younger investors. If you're in your 20s or 30s and you just start putting money into VOO every month, reinvesting dividends, and not touching it until retirement, you're almost guaranteed to build significant wealth. But it's also useful for older investors. Many retirees keep VOO as a core holding in their portfolios, often alongside bonds or dividend funds, to balance growth with stability. Let's do a quick portfolio thought experiment. Suppose you're 30 years old, and you start investing $500 per month into VOO. That's $6,000 a year. If you continue doing that until you're 65, and the fund averages just 8% annually, slightly below the historical average, you'd end up with about $1.5 million by retirement. And that's just from consistent contributions and compounding. No lottery tickets, no chasing the next hot stock. Just steady investing into one ETF. Now, if you wanted to reduce your risk a little, you might combine VOO with a bond fund like BND. Let's say you did 70% VOO and 30% BND. Your long-term returns might drop slightly, maybe from 8% to 7%, but your portfolio would be much less volatile, making it easier to stay invested during market downturns. One more point on VOO. The S&P 500 has been tested through every major crisis of the last century. The Great Depression, World War II, stagflation in the 1970s, the dot-com crash, the financial crisis in 2008, the pandemic crash in 2020. Through all of it, the S&P 500 has recovered and gone on to new highs. That's why investors often say, don't bet against America. Owning VOO is essentially betting on the long-term growth of the American economy. So that's VOO, the Foundation ETF. It's broad, it's low cost, it's battle-tested, and it's a core holding for millions of investors. But while VOO represents the market as a whole, some investors want a little more excitement. They want exposure to the companies pushing the boundaries of technology and innovation, the companies that could shape the next 20 years. And that's where our next ETF comes in, QQQ, the Invesco Nasdaq-100 ETF. Now that we've covered VOO, the safe, steady foundation, it's time to look at an ETF that injects growth and innovation into a long-term portfolio. QQQ, the Invesco Nasdaq-100 ETF. If VOO is the dependable family car, QQQ is the sports car. It's faster, flashier, and capable of producing huge returns, but it also comes with more volatility. QQQ tracks the Nasdaq-100 index, which consists of the 100 largest non-financial companies listed on the Nasdaq exchange. Unlike the S&P 500, which spreads itself across all sectors, the Nasdaq-100 is heavily concentrated in technology and innovation-driven companies. That means when you buy QQQ, you're getting massive exposure to the tech giants and disruptors of the modern economy. As of today, the top holdings of QQQ include Apple, the world's largest company, leading in smartphones and services. Microsoft, a titan in software, cloud computing, and artificial intelligence. NVIDIA, the leader in graphics chips, AI computing, and data centers. Amazon, e-commerce, cloud computing, and logistics powerhouse. Meta Platforms, parent company of Facebook, Instagram, WhatsApp, and investing heavily in AI. Tesla, electric vehicles, batteries, and energy innovation. Together, just these 6 companies make up over 40% of the fund. That tells you right away that QQQ is not as diversified as VOO. Instead, it's concentrated in a handful of high-growth companies. So, why do so many investors flock to QQQ? One word: performance. Over the last decade, QQQ has dramatically outperformed the S&P 500. For example, from 2010 to 2020, the S&P 500 returned about 13% per year. QQQ, during that same period, returned closer to 20% per year. That's a massive difference. Over 10 years, $10,000 invested in the S&P 500 grew to around $34,000. In QQQ, that same $10,000 grew to more than $61,000. And that's the magic of compounding higher returns. Even a few percentage points of difference annually can translate into life-changing amounts of money over decades. Let's run through the biggest advantages of QQQ. High growth potential. The companies inside QQQ are among the most innovative in the world. They dominate artificial intelligence, cloud computing, electric vehicles, semiconductors, and digital advertising. These industries are expected to grow massively over the next 20 years. Market leadership. The Nasdaq-100 is filled with companies that have strong competitive advantages, global reach, and powerful brands. Historical outperformance. While past performance isn't a guarantee of future results, QQQ's track record has been stellar compared to broad market funds. Liquidity and popularity. QQQ is one of the most traded ETFs in the world, with billions in daily trading volume. That means it's easy to buy and sell with minimal spreads. But let's be honest, QQQ isn't perfect. With higher reward comes higher risk. Concentration risk. Remember, the top 10 holdings make up over 50% of the fund. If just one or two of these giants stumble, the entire ETF takes a hit. Volatility. QQQ swings harder than the S&P 500. During bull markets, it soars. But during bear markets, it can crash much harder. For example, during the dot-com bubble burst in the early 2000s, the Nasdaq lost more than 70% of its value. Investors had to wait over a decade just to break even. Sector bias. QQQ is dominated by tech, consumer discretionary, and communication services. If tech underperforms, the ETF struggles. Unlike VOO, which is spread across all sectors, QQQ is much less balanced. QQQ is best suited for investors who are seeking growth and innovation in their portfolio, and who are comfortable with volatility along the way. It's great for younger investors with a long time horizon, because they can ride out the ups and downs and let compounding work its magic. If you're 25 or 30 years old and you invest consistently in QQQ, you could see incredible long-term results. For older investors nearing retirement, QQQ can still play a role, but usually in smaller amounts. Instead of making it the core of a portfolio, it might serve as a growth satellite, a smaller allocation that adds some upside potential without taking on too much risk. Now, one of the biggest debates in investing circles is QQQ versus VOO. Which is better for long-term investors? The truth is, it depends on your goals. If you want stability and broad exposure, VOO is the winner. If you want higher growth potential and you can stomach volatility, QQQ might outperform. Here's an example. Over the last 15 years, $10,000 invested in QQQ grew to about $70,000. That same $10,000 in VOO grew to around $45,000. That's a huge gap. But remember, QQQ also had periods of massive drawdowns. If you had bought it in early 2000, right at the top of the dot-com bubble, you would have lost more than 70% of your money in the next 2 years. And you wouldn't have broken even until around 2015 to 15 years later. That's why it's so important to understand your time horizon and risk tolerance. QQQ can reward you with incredible gains, but you need the patience and emotional discipline to hold through the painful downturns. So how does QQQ fit into a portfolio alongside something like VOO? One common strategy is to use VOO as the core, say, 70% or 80% of your portfolio, and then add QQQ as a growth kicker, maybe 20% or 30%. That way, you get the stability and diversification of the S&P 500, but you also get extra exposure to the innovation leaders driving the future. This combination balances risk and reward. If QQQ outperforms, you benefit. If it underperforms, VOO keeps your portfolio steady. Now, let's look forward. Will QQQ continue to outperform in the next 10 or 20 years? Nobody knows for sure, but here are a few things to consider. Artificial intelligence, NVIDIA, Microsoft, and Alphabet are leading the charge in AI. This could be the biggest technological shift since the internet. Cloud computing. Amazon, Microsoft, and Google are dominating cloud services, which are still growing rapidly. Electric vehicles and clean energy. Tesla and other companies in the index are pushing forward the transition to sustainable energy. Digital advertising and social media. Meta, Alphabet, and other platforms continue to control massive portions of online ad spending. These growth engines could propel QQQ for years to come. But we should also acknowledge risks. Regulation, global competition, and market saturation could slow things down. So that's QQQ, the growth engine of our ETF lineup. It's innovative, exciting, and historically rewarding, but also more volatile and risky. We've now looked at VOO, the foundation, and QQQ, the growth engine. But long-term investing isn't just about stocks. It's also about managing risk and ensuring stability. That's where our next ETF comes in, a bond fund that helps smooth out the ride. Up next, let's explore BND, the Vanguard Total Bond Market ETF. So far, we've talked about two stock-focused ETFs. VOO, which gives us broad exposure to the US economy, and QQQ, which concentrates on high-growth tech and innovation. Both are excellent for long-term growth, but as any experienced investor will tell you, growth alone isn't the whole story. To build a truly resilient, long-term portfolio, you also need stability, something that can help protect your investments during market downturns. And that's where bonds come in. In the world of ETFs, one of the most popular bond funds is BND, the Vanguard Total Bond Market ETF. BND is designed to give investors broad exposure to the U.S. bond market. It holds thousands of bonds across different categories, including U.S. Treasuries, government bonds backed by the full faith and credit of the United States, agency bonds, issued by government-related entities like Fannie Mae and Freddie Mac, corporate bonds, debt issued by major U.S. companies, mortgage-backed securities, bonds backed by pools of home loans. Altogether, BND provides a snapshot of the entire U.S. bond market, making it one of the simplest ways to add fixed income to your portfolio. Now, some investors, especially younger ones, might ask, why even bother with bonds? Aren't stocks better in the long run? And yes, historically, stocks do outperform bonds over very long time horizons. Monthly liquidity, quarterly dividends, easy to trade, and dividends are paid regularly. Of course, SCHD isn't perfect. A few drawbacks include sector concentration. SCHD tends to be overweight in financials, industrials, and consumer staples. That means less exposure to tech, compared to VOO or QQQ. Lower growth. While it's great for income, SCHD may not grow as fast as QQQ or even VOO over long stretches. Dividend risk. If a company cuts its dividend, the fund will eventually remove it, but in the meantime, income could dip. SCHD is perfect for investors who value income and stability, but who still want some growth potential. For retirees, SCHD is a fantastic option because it provides steady dividends that can help cover living expenses. For younger investors, SCHD can also be powerful, especially if you reinvest the dividends. Over time, those reinvested dividends compound, and your effective yield grows much larger. For example, if you start with a 3.5% yield and dividends grow by 7% per year, in 10 years your yield on cost could be over 7%. In 20 years, it could be double digits. That's the magic of dividend growth. A common question is, which is better for long-term investing, SCHD or VOO? The answer depends on your goals. VOO is better for pure growth and broad market exposure. SCHD is better for income and dividend growth. But here's the thing, you don't necessarily have to choose. Many investors hold both. VOO gives you exposure to the entire market, while SCHD adds a layer of reliable income. For example, you might build a portfolio that's 70% VOO and 30% SCHD while you're young. Then, as you approach retirement, you could shift more toward SCHD to increase your income. Let's run through a quick example. Suppose you invest $100,000 in SCHD today, with a yield of 3.5%. That means you'll earn about $3,500 per year in dividends. Now, if those dividends grow by 7% annually and you reinvest them, after 20 years you could be collecting more than $13,000 per year in dividends on the same $100,000 investment. That's the power of dividend growth investing. It starts slow, but over decades, it becomes a serious income machine. For retirees, SCHD is particularly attractive because it pays dividends quarterly, providing a steady stream of cash flow. Combine SCHD with a bond fund like BND, and you've got a recipe for a portfolio that delivers both stability and income, two of the most important needs in retirement. And unlike individual dividend stocks, SCHD automatically diversifies your income stream across dozens of companies. If one company cuts its dividend, the impact on your overall income is minimal. To sum it up, SCHD is one of the best dividend ETFs available for long-term investors. It offers a rare combination of high yield, dividend growth, and quality screening, all at a very low cost. It may not deliver the explosive returns of QQQ, but it provides something just as valuable: reliable, growing income. For many investors, that's the key to financial independence. So, what are the best ETFs for long-term investing? VOO gives you the whole US stock market in one simple fund. QQQ captures the growth of the tech sector and innovation leaders. BND stabilizes your portfolio with bonds. SCHD provides income and dividend growth. Together, they create a portfolio that's diversified, resilient, and built for the long haul. Remember, there's no perfect portfolio. The best portfolio is the one that matches your goals, your time horizon, and, most importantly, your ability to stick with it through ups and downs. So whether you're just starting your investment journey or fine-tuning your retirement strategy, these 4 ETFs give you a rock-solid foundation for building long-term wealth. If you found this video helpful, make sure to like, subscribe, and share with a friend who's interested in investing. And let me know in the comments, which of these ETFs do you own, or which one are you planning to add to your portfolio? Thanks for watching, and here's to your investing success.